Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment's brought to you by Bull Realty Asset and Occupancy Solutions. Visit bullrealty.com. Today we're talking about Viewpoint, the 2017 Commercial Real Estate Trends Report by Integra. And we have Hugh Kelly here with us and Anthony Graziano, the commercial real estate expert. And before the break, we were talking about some of the impacts of interest rates. We were talking about multifamily. And I'm curious, you guys, your opinion on the rising interest rates impact on the multifamily market. We're starting to see, as you mentioned before, a little bit of pullback from investors, maybe a little bit of hesitancy even from lenders who've always loved multifamily. What impact could rising interest rates have on that sector?
Sure. So, one of the big things that we're seeing in a lot of the markets, obviously, is a tremendous amount of construction. We've been building. We started the multifamily construction resurgence probably back in as early as late 2011, early 2012. The real construction started in 13 and 14. So you're talking about like 2-year lead time for construction. So what we're closing out now is this construction that started in 13 and 14. The rising interest rate environment is going to do two things. If it presses capitalization rates up, it's going to be harder to get those deals to close. And if rents compress because there's more supply in the market, so rents are going to start to come down as supply enters the market, the institutional investors aren't going to be getting the revenue that they thought they were buying. We're already starting to see that. I think if you look at our Viewpoints publication, this year we started to see a pullback in the overall volume of multifamily deals, and a lot of that comes back to, do these deals make sense? Number one, were the capitalization rates, risk-adjusted rates sensible? And I think some people have made some decisions on that and started to change markets they're investing in. And then the second thing is, are the rents going to hold up? As new product gets delivered, we're going to start to see rents go down in some of these markets, or at least not grow as quickly as they were performing. So this is going to be a lumpy year for multifamily, I think.
Interesting.
I mean, the one thing though is that no one who has a breath, no one who has a heartbeat, is surprised by the rising interest rates. We've been waiting for this for 3 or 4 years now, and it's been dribbled in by the Fed. And finally, it looks like for macroeconomic reasons, the Fed has said it's time for us to begin to create some space for us above the zero interest rate bound, so that the next time that we have a cyclical downturn, this is such a cyclical business, we have some policy levers to play with. And I think yes, rising interest rates, but rising from a very, very low level, one that anybody who was invested and had a chance to make sure they locked in a long-term rate at a fixed rate has done so, and they still have an opportunity to do that, at a comparatively low rate. So this is still a good environment for investors.
Yeah, and it's good news, right? Their economy's doing well. Hopefully the occupancy continues to climb. More businesses are expanding, more jobs are created. So it all helps out. And it's interesting to note, you talked about cap rates potentially increasing, and we just did an analysis on a property for a client the other day, and a 50 basis point increase in cap rate reduced his value by $2.3 million. So, and I'm going to ask you a general question, and I know it depends on the property and the location and the sector and the price range, but generally speaking, is it time to sell now? Is it time to sell, or is it time to buy?
Sure.
We seem to have more buyers in our shop than sellers, but is it time to sell? A lot of people have sold, right?
Yeah. I mean, look, I would never encourage clients to sell just because capitalization rates are changing, right? Capitalization rates are always changing depending on a lot of factors: the condition of your property, how recent your capital investments have been, what the long-term run rate or perspective of your market is. But I think a lot of people have been selling. I think a lot of the activity and a lot of the commercial activity that we've seen over the last 2 years has been profit-taking. People bought in 9, 10, they layered their value-add investment in, they raised rents, and now they're profit-taking. And I think that we certainly have seen that in 14 and 15. And I think you were taking more profits because you also had positive leverage. But again, I agree with Hugh that the interest rates are priced into the market at this point. They've been priced into the capitalization rates. So I don't think anybody should run to the market and say, I have to sell in the next 6 months because cap rates are going to go up, tremendously, and it's going to crater my value. I think that it's been a measured, known factor that's been in the market. Quite frankly, since in some quarters, it was surprising the interest rates didn't go up. People were expecting them to go up, and they didn't. They've been going up much more slowly. I think if the Fed holds to its policy of more consistent rate rises this year, you are going to start to see it show up in the capitalization rates. Our publication actually demonstrates that we still haven't seen big swings in the cap rates yet, even with the interest rates rising. So we think it's priced into the market already.
Yeah, and the most recent evidence says that cap rates are remaining very solid. The question behind your question is then what's the reinvestment opportunity for that money? If you take profits, then what are you going to do with those profits?
Buy stocks.
Sure, they're real cheap these days, aren't they?
Right.
Yeah, that is a good question. And let's talk about REITs. You mentioned stocks. I mean, as we read Viewpoint and we're looking at, hey, what's going to happen moving forward? What about REITs?
So, REITs generally hold a big cushion of equity within their overall portfolio. So they're not heavily levered, which always gives them some security. The difficulty with REITs is two factors. One, the implicit value, the underlying intrinsic value of the REIT stock is driven by cash flow. So if you believe that cash flows are going to take a hit, then you have to look at the pricing of REITs. You also have to look at the segmentation of the REIT market. You have REITs that specialize in particular asset classes. I wouldn't favor a retail REIT at this particular time, right? But the third thing is that the benchmark values for the REITs are also based on appraisals. So they're looking at their appreciation and their accretion based on quarterly reviews of where they're going. And the question is, when the market's changing, you have to look at the underlying reliability of the perspective of those appraisals that are going into the REIT pricing. So I think in terms of net asset values, and the REITs are relatively stable because they're low leverage, but I think it's going to be harder for them to acquire in this environment because as they lose revenues, that's going to hit their stock price, which is going to affect their ability to raise capital.
So are you saying then, except for retail REITs, that they're safe, but there might not be that much growth moving forward? Is that a fair?
Yeah, I think it's going to be harder to see the kind of growth that the REITs have experienced over the past 3 to 4 years in the next 3 to 4 years, because I don't think the income growth is going to be there.
Because when REITs, this generation of REITs emerged in the 1990s, they emerged as growth stocks, and that's because they were able to acquire properties at substantially below what their replacement cost was. Once they hit that threshold, they stopped being growth stocks. They started being cash flow stocks. Right. They became utility stocks. I actually think that a cash flowing stock is going to be very attractive. If we believe from the point of view of the stock market that we've reached a market climax, or we'll hit a market climax very soon. And then secondly, in the real estate markets, if we begin to see volumes begin to come off their peaks, we've seen a tremendous amount of appreciation. That's why people are taking profits, and now we're going to be in a phase of the cycle where it really is cash flow that's right. And REITs are great at delivering cash flow. By statute, they have to turn their cash into dividends.
All right, we're going to take a short break. When we get back, I'm going to ask you guys about foreign investment in the U.S. It seems like we've had a lot of that. Well, with Trump, is that going to slow down? We'll find out next. Stay with us. This is America's Commercial Real Estate Show. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.